Good morning, ladies and gentlemen. Since the foundation of this institution, almost 25 years ago, we always begin our distinguished lecture forum with special lecture on the global economy and the global economic outlook with Dr. Alan Sinai. You know, economic forecasting is rather hazardous business, but Alan Sinai has been in the business almost 4 decades. But he is not just surviving in the business, but he's thriving and prospering in the business. In fact, he has been highly praised by Wall Street Journal and Time Magazine as the best forecaster in the United States. He is actually almost a legendary figure in the field of economic forecasting. He began as academic. He began his career as econometric model builder for the U.S. economy and the world economy with Professor Otto Eckstein of Harvard University. And you know, at that time, it's well known as DRI, Data Research the Incorporation, along with WEFA, which was led by Nobel laureate Larry Klein. So Alan Sinai has been around in the business of forecasting for many years, and we bring him here every year, particularly at the New Year's time, and the beginning of the New Year, to enlighten us what is happening in the world and what is going to happen in the world. And actually, it turned out that his forecast was every year the most actually accurate and the right on the ballpark. As I said, it's always difficult because there are so many uncertainties in the future. So it is very difficult to have good forecasting, but Alan Sinai has been on the ballpark on most of the time. Again, since you know him so well, I don't think I will waste any more time to introduce you. It's outstanding, the career. Well, with this, I just would like to invite him to the podium, and please join me in welcoming Dr. Sinai.
Thank you. It is always, for me, at the beginning of a new year, a delight and pleasure to come here to Korea, where things have been good for so long, but they're going to get better. That's one message of this morning's remarks. They're going to get better for Korea and the world. Better times are ahead. It's hard to see that here in the near term when so much is going on around the world. Conflict between Russia and the West, plunging oil prices, gyrating financial markets, currencies which can't stay fixed, getting unfixed, the Swiss move in the last few days. And the question about the Eurozone, whether the Eurozone will hold together. And then the normal business cycle processes that go on in every economy. For this year, there are a couple of things to keep in mind. One is that oil prices have plummeted, hugely so, and by almost 60% in a very short time. That sets up movements in finance, and in economies around the world where many are hinged to oil and to the energy sector for tremendous weakness and volatility. The second, so this is ahistorical. This is a black swan-like event. It's what we call a tail risk. Suddenly, although it was in process for quite some time, between June and the current time, crude oil prices down hugely, jumbling and shaking up not only economies, markets, but the geopolitics of the Middle East in ways that you cannot quantify in models. Just from this alone, you should expect much more volatility in financial markets and surprises in economies' performance, and in inflation. Results that will be nonlinear, because this event is a nonlinear event. Thinking in terms of averages, the standard trends, goes out the window when you have this kind of ahistorical move. The last time crude oil prices fell this much was during the period of 1985-86. Other conditions were different. Huge shock waves resulted. A lot of surprises. In the 70s, we had a quadrupling of oil prices between 1973 and 75 from very low single-digit levels, a doubling over 1978 to 80. And always when crude oil is involved, you end up in geopolitics, because oil and natural resources are one of the strategic prizes in the world. And we have to understand, I think you all understand, that for Russia, for Saudi Arabia, for the OPEC countries, and now for the United States, oil is a jewel. There is no country that shouldn't care about having a big piece of that jewel, because wealth follows the producers of oil. The OPEC countries and the share of wealth that went to the Saudis and OPEC countries when they raised oil prices during the 1970s, the wealth that shifted to Russia, the billionaires that shifted to Russia as Russia became the world's #1 crude oil producer, and now wealth shifting to the United States as the United States joins the biggest oil producers in the world, Russia and Saudis, in the game. Oil is a strategic prize. Second, unusual from a business cycle point of view, aspect of today's world is plunging currencies against the dollar and the huge strength of the dollar. I have never seen in all the years, yes, it is about 40 years, 4 decades. I'm still walking. A lot of scars, but they all come from my wife. But I'm still walking around. I have never seen trends in the currency markets as pronounced as what is going on now. Why is that? It's because so many central banks now have an inflation target, and they didn't used to have an inflation target. Central banks now run the currencies. The currency movements are a byproduct of central banks pursuing inflation targets, and they're all behind. The European Central Bank with inflation minus 0.2% year over year and a target of 2%. Japan with an inflation rate of X food and X the tax increases 0.7% year over year, and they're aiming for 2%. The U.S. With inflation now headed for under 1 year over year and a target of 2. The UK is okay on inflation targets, and so is Canada. But for those countries that are behind, the way of the world in this business cycle is for central banks to announce an inflation target, and in the aftermath of the financial crisis, since zero interest rates didn't work, since pumping funds into the banking system didn't work, to use quantitative easing to directly affect asset prices and then rely on asset prices and the channels between the changes in asset prices and the economy to get economies back up and running, and then with lags for price inflation to come back. The letting go of the currencies in the name of pursuing inflation targets, currency movements as a byproduct of shooting for an inflation target where central banks print money. And so the currency, where that happens, falls against other major currencies like the dollar, is very new. The currency traders have open territory for the yen, for the euro, a little bit for the yuan, not that much. It's not a target currency. And in the aftermath of what the Swiss National Bank did, there will be other non-euro currencies that will be sold by the traders. TRADERS is how I spell that. Because it's easy pickings. It's easy pickings. No policymakers are going to interfere with these currency movements if they're being done or they are a byproduct of an attempt to achieve an inflation target. The inflation targets are new. The United States installed an inflation target in 2012, so it's new. And the currency movements, as a byproduct of pursuing those inflation targets by central banks, are new. Central banks don't have to, countries don't have to intervene anymore to drive the currency down. They just print money. Well, the kind of movements in currencies that we have seen and are likely to see, very strong uptrend in the U.S. dollar, down on the yen against the U.S. dollar, down on the euro against the U.S. dollar. We think a little bit down on the yuan against the U.S. dollar, but the yuan relatively stronger against the yen. They are very pronounced, and they are creating and will create waves in financial markets, volatility, and surprises. So we have three reasons for me to tell you I'm not sure about forecast accuracy this year. There are very unusual economic events going on. The collapse in oil prices, the tremendous strength of the dollar, tremendous weakness fast over the past couple of years in the yen, accelerated weakness in the euro, and inflation targets by central banks in terms of running economies that already have, are, and will create a lot of surprises and a lot of volatility. On top of that, add a wave of low inflation, not seen in decades for most of the world, and you have a recipe, you have a pot of unusual things going on that make the hazardous work of forecasting even more difficult. So I think last year we had a very good year of forecasting. We kind of nailed the U.S. economy. I think we came very close, if not almost to the decimal point on the Korean economy. Maybe we were a little stronger than you're ending up with, but very, very close. We certainly did not expect inflation to be this low. We thought interest rates would rise, and they went down. But we really did nail the U.S. And world stock markets. By nail, I mean we got it quite right on. And we did amazingly well on the currencies, which are probably the hardest thing to forecast. And I will promise you we won't do as well this year. But what I want to do today is to give you a look at, having warned you in advance, volatility, surprises are really a theme. All kinds of things, unexpected, are supposed to occur on the basis of what I told you exists out there because they're off the map, they're unusual. Every one of those four dimensions of factors that I mentioned. And your mindset should be away from thinking in the box to thinking outside the box and being sensitive to surprises of various kinds. So what I want to do is to talk about the basic prospect for the U.S. and the world. It is sanguine. It is a very nice outlook. in the U.S. and global business cycle, despite all of the problems and weakness in Japan, and struggle of Japan, troubles in the Eurozone, slower growth in China, the developing world, the emerging countries doing a lot worse in growth than they used to. Lots of credit issues underneath. China slowly trying to fix what's wrong underneath in the Chinese economy. Too much margin debt, excessive exuberance by individual investors. That's part of the restriction in lending that China just did. It caused the Chinese stock market to go down 7 to 8%. But that's after a 50% rise. But really, I think the right thing for policymakers and regulators to do is what we see in China, to shake it out. You can't let that kind of behavior underneath, shadow banking system, too much property lending, excessive real estate building. Case of China, go on, that has to be squeezed out. While at the same time, China is easing monetary policy to try to hold the growth rate up. I think that's the right track, actually, for China. So we're bullish on China from a stock market point of view. And we're thinking the Chinese economy next year will do better than this year. This year, about 7% growth. We'll see. But the basic prospect for the world, the U.S. and world, is positive and sanguine. And then I want to go into some of the risks and take you through the analysis of some of the things that might go wrong. The U.S. prospect is one of a normal business cycle expansion now and normalizing monetary policy by the Federal Reserve. By normal, I mean the kind of performance growth, jobs growth, income growth, and financial performance that you see in a normal U.S. economic upturn. We think that the U.S. Expansion normalized in the second half of 2013. And our description of what was coming since then was that the U.S. was finally out of the, what I call the Reinhart-Rogoff world. You know the world I mean, the very fine work by two economists, empirical work where they showed a number of countries who went through financial crises taking anywhere from 6, 7 to 10 years to work their way out of it. And rather than think about the U.S. in that light, about a year or so ago, I began to talk about, forget it. That's history. It's gone. Look ahead. The U.S. is lifting off. It's business cycle-wise looking more normal. And its growth rate, the U.S. growth rate, will pick up. It did. In 2014, fourth quarter over fourth quarter, it looks like 2.7%. The reason I'm telling you about some of these good forecasts is I really have my superstitions about this year on forecasting. That's pretty much what we said, and it didn't show up that way until we got revised data, third quarter real GDP data that helped us out. That was a pickup in growth, and this year for the U.S., real GDP growth, we are projecting at 3.6%. And in 2016, 3.9%. Now, those growth rates of real GDP include the estimated effects of the huge decline in oil prices. That's very tough. Is the lower oil prices net over time help U.S. economic growth, lower inflation, lower the unemployment rate, create net, not in the energy sector where jobs are lost, more jobs. And because of the lower inflation, the Federal Reserve, which has a 2% inflation target for the first time in its history, has to figure out how to normalize monetary policy when inflation is declining and moving away from the 2% target. That's tough. That's going to be something our Federal Reserve will wrestle with all year. Never before having to deal with that, except in the 1990s, there was a period of time where something like this happened. The addition to growth, based on the assumption that crude oil prices are permanently lower and that the decline is mainly a supply shock supply-side shock, exogenous, but not fully so, is 3.6% against still a very good growth rate before the oil shock of 3.3%. And in 2016, 3.9 against what we would have forecasted at 3.6 or 3.7. Adds to growth. Is that decisive on inflation, on the overall consumption price deflator? That's the inflation indicator the Federal Reserve watches to make monetary policy and to calibrate, at least up to now, that's what they have done, to calibrate making the price stability target of 2%. Inflation this year on the overall index, we're estimating at about 1.25%. Could go lower. And next year, 1.5 to 1.75. So in not until 2017 do we see the inflation rate in the U.S. getting back close to the 2% target. If they keep that calibration, I think they will. 2% is the ingrained price target for lots of countries. The U.S., as you know, is the only place where the central bank has a dual objective. In the U.S. case, it's full employment and price stability. Full employment, to complicate things more for ordinary mortals like me, is defined now by the Federal Reserve, and they changed the definition over the past year as an unemployment rate of 5.2 to 5.5%. That's the collective central tendency of member forecasts for the full employment rate of unemployment, 5.2 to 5.5. We stand at 5.6 now. But they added to that something called slack. There are about 7 indicators that define slack. So full employment will be not only the unemployment rate getting into the current estimated range, but also slack diminishing in the labor market. For example, a lot fewer part-time workers who really want to work full-time, just like here in Korea. That's one of the indicators that needs to improve before the Federal Reserve will conclude there is full employment. Another indicator, which is an important one, is wage inflation. And in the United States, like a number of other countries, wage remuneration is very low. And so the Federal Reserve won't think the labor market is really tight until they see wage inflation picking up. And they'll wait to see wage inflation pick up quite a bit before they think the labor market is really tight. And the inflation goal is 2%. But with the oil shock, we are forecasting the unemployment rate in the U.S. at the end of 2015, December, at 4.8%. That is below the full employment rate of unemployment. Without the oil shock, we would have been forecasting 5 or 5.1. And so the macroeconomic performance statistics of the U.S., which would have been good anyway, will be even better if the big decline in crude oil prices stays. The shock is permanent, and the effects of lower crude oil prices work their way through markets, through the energy sector, and affect a number of countries. The U.S. is a net consumer of oil. We are producing in excess of 9 million barrels a day of crude oil. We are the 3rd largest oil producer now, and when you put in natural gas, the U.S. is arguably number 1 in the world. That is an extraordinary change for a country that was hardly in the game production-wise for so many years. What happened? It's called fracking, a technological innovation which for the suppliers and the drillers allowed them to drill horizontally into shale rock to get oil and gas out and to add to production. The U.S. ahead, once again, in technological innovation that has made a huge difference. What has it done? It has vaulted the United States into the big 3 of oil producers. And if we can only get our consumption of energy down, we someday might end up as a net supplier of oil with a much bigger production figure. This could be 5 years out, and 9 million barrels a day. Someday oil prices will go back up, and think of all the wealth that will shift to the United States, away from others who will not be in the big 3 or 4 of the oil producers. The U.S. is the new kid on the block in oil production. And this is part of the supply side of oil, along with the geopolitics of Saudi Arabia in an attempt to get more market share, has increased the supply of oil relative to weak demand because the world economy is weak at this time. And that started oil prices going down last June. The traders picked up on that. Oil prices, depending on the measure, at $110 a barrel, it's a fiction, could just as easily be $50 a barrel. There's a huge premium in there that goes beyond demand and supply. It's a very tradable item. It's an investment item. And down it went, like that. The black swan event. But where did it come from? It came from disruptive technology, a U.S. invention. Technology, something the United States somehow manages to do better than anywhere else in the world. Time and again, when we need to be bailed out, we get bailed out by technological innovation. Computers, the internet revolution in the 90s, the move to web and internet-based production and servicing that exists in the United States, and fracking, a technological breakthrough in the production of oil the U.S. created that has vaulted us into the supply side of oil, makes me argue that this is a permanent decline in the price of oil, and then from that, we have to work our way through figuring out what it means for economies. Net oil consumers, like South Korea, benefit from lower oil prices of this magnitude. And so that's why I said that if the figures that I will give you for our view on Korea this year are wrong, it could be better, and you could get surprised. And on inflation, which already is low in South Korea, it could be lower. It could be lower, and that could be a surprise here in South Korea. So oil is a big lever. And our view is that the oil price decline is permanent. More supply for some time relative to demand. The lower oil prices, of course, will take some suppliers out of business, and they will reduce supply. But the American companies that are now in the shale oil production business, American companies are very good at finding ways to cut costs to lower break-even points. They will stay in the game. They're already firing, U.S.-based companies are firing employees left and right to get costs down. But they're still producing at shale oil. They're not going out of business. Countries who are in the oil-producing game, OPEC, and the OPEC countries, and what we used to call the cartel, some of them will be out of business, in our view. Venezuela, it'd be amazing if Venezuela doesn't go bankrupt. Russia, big question mark. The biggest net oil supplier and gas supplier in the world. These declines in crude oil prices hit Russia very hard, and the Russian economy is already in a lot of trouble internally, but also from the sanctions that the Western world has imposed on Russia on the political problems with President Putin. We are estimating the Russian economy this year to be down anywhere from 5% to 10%. That's a depression. And down again next year, 3 to 5%. Raising the question of what will happen and whether Russia will go bankrupt. By that I mean default on debt and devalue. Well, the market has devalued the ruble already. It is down massively against other currencies. Russia has tried to defend that with reserves and by raising interest rates. That is not working. The real question geopolitically is, what does a cornered Vladimir Putin do with the Russian Empire crumbling around him? Does he get more warlike? Does Russia shut down a couple million barrels a day of oil to raise prices? Think what that would do. Biggest supplier in the world suddenly cutting back. Or what? Similarly so, Iran, Iraq, Nigeria, Middle East countries, smaller producers of oil, hurt badly by this huge oil price decline. And back of it all is the following hypothesis and assumption. Could be wrong. It's an assessment of the geopolitics of oil and the role of Saudi Arabia. If I'm Saudi Arabia, looking ahead to the future, and who will be the big producers of oil, seeking that strategic prize of oil and wealth and a big portion of it, I think I would have to assume there will be three big oil producers, Saudi, Russia, and the U.S., and get rid of or shake out the high-cost, lower production countries, so that I, along with a couple of other big oil producers, dominate the price structure and can set it. I think that's their strategy. It's geopolitical, it's economic. It is an understanding, of course, in my view, by Saudi Arabia of the prize of a big share in oil. It's a very wealthy area. It doesn't always filter down to people. And they're not going to let go of it easily. And this is part of the strategy. This is part of the game. It's what we call, in terms of industry structure, the movement toward an oligopolistic structure with several big sellers setting prices and a lot of little producers. But there are going to be casualties. Venezuela is a casualty. Not clear what will happen to Iran, big, good-sized, small, but good-sized oil producer. China's a producer of oil. And these will be the losers. In the United States, the state of Texas, Oklahoma, states Alaska, Louisiana, huge casualties of the decline in oil prices. And those banks and financial institutions that have paper outstanding to any of the energy companies, people in regions where energy businesses have been booming but now are collapsing. Anyone with debt out to Russia, no one should touch the ruble. It may disappear. Russia might just devalue it even more. Stay away from all of that until this all shakes out, all driven by oil prices. There are winners. Japan's a winner. Korea's a winner. The U.S. is a winner. Canada is kind of a loser, big oil producer. Mexico, a loser. Brazil, a little bit. And so in the countries that we analyze, given this huge decline in oil prices and the assumption that it stays and the thinking behind it that I've shared with you here today, we are expecting and working through numbers to see surprises in growth all around the world as part of what goes on, but part of a trend which over time, because lower oil prices are a net benefit to the world economy at large, will produce more growth for the world economy, less inflation, more jobs, a lower unemployment rate. And because of less inflation, allow central banks to stay easier longer, to cut interest rates where they might not have cut them before, or where they're going to tighten and raise interest rates like the United States, do it more gently than they would otherwise. Low interest rates always help because they help stock markets. Low interest rates, strong stock market helps consumption, helps the economy. So we are net positive on the oil price collapse and the U.S. prospect of a normal business cycle expansion, 3 to 4% growth, and a Federal Reserve, in looking at that and getting close to full employment, will start to raise interest rates sometime around the middle of this year. But the rate increases by the U.S. will be slow because inflation is going to be far away from the 2%. And so with a dual objective, the Federal Reserve will be conflicted. The economy will suggest because of where we are against full employment, that the Federal Reserve ought to raise rates. Inflation, moving down and away from 2%, will suggest that they should not raise interest rates, normalizing monetary policy to the now rather promising U.S. business cycle upturn and higher growth rate does say we should have positive rates. In fact, of all that is going on in the U.S. economy, everything looks normal. What doesn't look normal with zero interest rates. It's really the oddball item to have zero interest rates when you have an economy that is really kind of cooking. Now, for the world this year, the U.S. is a big deal because the lift up in growth, because the U.S. buys so much from around the world, is going to help pull up with lags other parts of the world. So we are now back to a more normal situation in the world business cycle where the U.S. is the engine of growth, and that is a theme for us. Last year, we thought the U.S. would be an engine of growth, but we expected Japan to do better than indeed it did. We thought China would move sideways, and indeed it has. And we thought the Eurozone and Europe would pick up a little bit. Indeed it did. And we did think the developing countries would grow more slowly. And so in 2014, we had a disappointing year. But the rest of the world didn't perform as well as I thought they might have. And so other parts of the world need more stimulus. Japan gave its economy another dose of extra stimulus through an increased amount of quantitative easing a couple of months ago. The ECB and the Eurozone is finally coming around to the only way monetary policy can work this time through asset prices and quantitative easing. Quantitative easing works. It worked for the UK. The U.S. performance statistics make it clear that quantitative easing has worked for the United States. We believe it's working for Japan, but you can't see it easily yet in Japan, in part because fiscal restraint, a tax increase, weakened it, and in part because it takes so long for the improvement in asset prices, a lower currency, a better stock market, lower interest rates, before those changes in asset prices work their way through various channels into the economy, lift an economy, and then with lags lift price inflation. In the U.S., the economy is lifted. In the U.K., the economy is lifted. In the U.S., even without oil, we would not have a pickup in inflation. There are long lags between an economy that lifts up and off and price inflation. Price inflation of any size is a long way away, and in between we've got the oil price on top of it, part of commodity price deflation, keeping inflation rates low, and we're in the middle of it. While you're in the middle of this process, it will not look like it's working. In Japan, where I go tomorrow, I think the thought of Japanese is that it isn't working. The quantitative easing is helping only the upper income stratum of society. That's true. That's how it works. And later on, after the asset price changes work their way through the economy and you get a lift up in the economy, it's the economy that then picks up jobs for ordinary people. And only then do they begin to realize that it might be working. But right now in Japan, I can tell you, and probably here in Korea, though you haven't had to, thank God, do quantitative easing, everyone thinks it's not working. And same thing was true in the United States, but I don't think there are very many people now in the United States, analysts or otherwise, although ordinary people don't quite get this, that will think that quantitative easing it has not worked in the United States. The evidence is crystal clear that it has worked. It's crystal clear that it worked in the UK. It is working in Japan. In our view, we're in the middle of the process. It will work in Europe if they really do it and stick to it. And we'll see later this week what the ECB has in store for us in terms of quantitative easing. If the ECB is smart, Mr. Draghi is very smart. I've never seen a central bank head get as much out of the markets as he does by talking. It's amazing. But they really have to deliver on the goods and buy sovereign debt in some form or fashion, along with the other measures they're using, to get that economy going. They should overdo it, in my view. They should do $700 billion, not $600 billion, of sovereign debt purchases. It's a tough call because some of the bonds they'll be buying are bonds that are really have yields so low. German bonds are 0.4%. And so interest rates in Europe, because of the expectation of this, are falling. Long-dated securities and short-term rates in some countries are going negative. So putting funds in banks in some countries means you have to pay the banks to hold the money. Unprecedented. And that will be more pronounced depending on the program that is announced by Mr. Draghi this Thursday. $700 billion seems to be beyond what they're planning. They should buy a whole range of securities, including the government bonds, to get maximum benefit out of it. But here's how quantitative easing works in an area like that, and an area like Japan, through the exchange rate. In the United States, in any country where central banks are easing to stimulate economies, the asset prices are interest rates, price of bonds, short and long term, stock market, and the currency. In the United States, we think the work was really done by interest rates and the stock market because of the nature of our economy. And we are up and running now, and the glowing statistics, if it happens, I presented to you, come out of the leverage of interest rates and the stock market and how that works in the U.S. economy. A lower dollar did help, but exports in the U.S. are a relatively small part of GDP. In the U.S., it's all around the consumer. Consumer, by the way, in the United States, $12 trillion. That's larger than all of the European Union. So if the American consumer lifts in aggregate the growth rate and it is starting to tilt up, nowhere near what it used to be, there's a lot of room for faster growth, think what that will mean for the rest of the world, for Korea, for Japan, for China, for Europe, for where we buy, American consumers buy. And with a strong dollar, Americans may actually come out here more than they have in the past. I actually we'll go to Tokyo tomorrow. But last year I thought it was relatively cheap. Tokyo. I never thought I'd say that because the yen was on the move last year. Now it's even going to be cheaper. I'm getting a hotel room there for $230. I used to pay almost $400 a night. And I'm sure when I do my purchasing parity purchase of Tony Roma's Ribs, that's a place in Roppongi, and I go there, have the same thing every year. The prices there don't change much, but the currency movement. So I remember one time I paid $100 for a slab of ribs, onion soup, and iced tea. And then there was one year I paid $20. Last year was $43 after the conversion. This year, my guess is it'll be somewhere around $30, $35. I never thought I'd say that I thought Japan was getting relatively inexpensive compared to Paris or London. Wow. And here in Seoul, well, I haven't sampled enough places to see. I think Seoul, Korea looks a little more expensive to me right now than it does Tokyo from a dollar-based investor. Well, for Japan and for Europe, the main lever of impact is through the currency. Germany, 40% open on exports. And so to really get something going in the economy, the currency has to fall a lot, and the same is true in Japan. So hence, quantitative easing, where it's done, has a big effect on the currency, so that on the yen, our view remains still a major downtrend in the yen. This view began at about 75 to 80 on the yen. We're now, our directional point on dollar yen is 130 to 135, and that's for 9 months down the road. Not right away, but head in that direction. We are expecting another dose of quantitative easing. We're forecasting that by the Bank of Japan. We'll see if it happens. The reason is their economy is still not doing well, and inflation is moving in the wrong direction against their 2% target. They have that 2% target. To get it, they're going to have to pump even more funds into the system. And yeah, it's a fiscal action. In Europe, our view now on dollar-euro is parity, 1 for 1. And that's about a 1-year view. But why? Same reason. For the Eurozone economy to get up and running from inside, easy money is going to have to work so that it drives that euro way down against the dollar and other currencies. On the dollar side, the U.S. looks great. The best place now on a trend basis to put funds looks like the dollar. We're growing nicely. Inflation's low. We're about to reach full employment. Central bank is going to raise rates. Other parts of the world will not raise rates. The U.S. budget, our last federal budget deficit was 2.8% of GDP. 4 years ago, it was 10% of GDP. Can you believe it? We're actually making, there is no budget deficit problem right now. And people are beginning to feel better in the U.S. And in the political system in the United States, there are signs that we may get some agreement out of this Democratic president in his last 2 years, or some things that could get through. The dysfunctionality of Washington is still there, but it's better. Look, euro and yen as your home-based currency. You want to be in cash. So you put it in cash at 0.3% or something like that, long-dated securities. You know the yen's going down because everybody in Japan knows the country wants the yen to go down. Nobody's getting in the way of that. That may change this year. Getting in the way of it, you're losing money. Where do you go? You put it in 10-year treasuries or some fund that deals with U.S. treasuries, 1.8%, 2%, and you get the kicker from the dollar. That's a hefty return for cash. And what can be safer now than U.S. paper? We see the home bias of keeping money at home in Japan shifting and money coming out of Japan to other parts of the world, something we have not seen in 20 or I think 30 years. So the currencies, downtrend, uptrend for the dollar, uptrend for the Swiss franc, at a certain point, safe haven currencies, and nobody in the way to stop that. No policymakers are saying that these currency moves have gone too far, too fast. The minute anybody says that, we'll have vicious reversals in the movements of the currencies in the opposite direction. And that will reverberate through financial markets and add to the volatility. I think that's going to have to happen sometime this year because otherwise the currencies will overshoot and create a whole bunch of other problems. So we're looking for Japan to pick up later this year and next year, another dose of easier money, of quantitative easing, and for the Eurozone growth rate, last year 0.8%, this year 1.3 to 1.5. Japan in 2014 at 0.4, growing, picking up to 1.3 to 1.5. UK maintaining 2.5 to 3, and the US pickup. The US as an external shock, so to speak, helping other economies export it to the United States, and then within other economies, easier money through QE, that's Japan and Europe. China continuing to ease money. With lags, the world economy should do better. And next year, 2016, this year, up from last year's 2.5%. This year, up to 2.9, 3%. Next year, 3.2 to 3.5%, 2016. Better times ahead. Better times ahead is the theme. Well, as far as financial markets go and asset prices and asset allocation and investments, this view of improving U.S. or improved U.S. economy that helps other parts of the world and an improving global economy over the next 1 to 3 years means that on a relative value basis in terms of total returns, as you would expect, we are very overweight in equities. The volatility here at the beginning of the year has been huge. What I'm saying now is a trend view. That has been our view of equities, particularly in the United States, since March since before March 2009 remains our view. Because with growing economies should come growing earnings. Interest rates are going to stay low. Fundamental valuation says stock markets go up. Last year, the relative value performance in the broad asset class equities was far greater, even though the total return on fixed income was up because interest rates came down. So we are, and this is a risky view, 85% allocated to the broad asset class equities, and we would apply that to the world against a neutral benchmark of 55%. Wow. So look beyond what's going on in the volatility today and longer run. We are buyers and we are investors in equities as an asset class. We're underweight in fixed income. That doesn't mean we think interest rates anywhere are going up. Indeed, they may go down some more. But on a relative value basis, from an investment point of view, underweight on fixed income. And we now allocate a little money to cash because for the first time in 7 years in the United States, we're going to have a little return on cash. But certainly zero cash in a country like Japan, zero cash. Waiting in the Eurozone, rates are zero. Central banks are quantitative easing. The place that you have to be as an investor in Europe and in Japan is in equities. Korea looks good to us. We are estimating this year 3.4%, and I think somebody told me that's the, we estimate that the country did 3.5 last year. So I recall I might have been a little higher than that. In 2015, 3.4% growth. 2016, 3.7% because the whole global economy, China will be doing better, Japan will be doing better, the U.S. will be doing well, pulling up through exports, Korea. Inflation in 2014 looks like it was 1.3%. Like lots of other countries, inflation is running low. 2015, because of oil, we're estimating 0.8 to 1% inflation, average for the year, and higher but still low in 2016. The unemployment rate, it looks like it did 3.3% in 2014. We're estimating 3.2 in 2015, 3% in 2016. That looks like on the surface full employment. Now, I know there are a lot of part-time workers. There's unhappiness in terms of workers in Korea about how they're doing, but these are enviable statistics. On the won, currently, I think today about 1077, down 2% to maybe as much as 5% against the dollar. So that's an 1100, maybe as low as 1125 to the dollar, pretty stable. And we're expecting the Central Bank of Korea, to manage monetary policy to help keep the won stable. The mystery to me is why the stock market for 3 years has done so poorly, and so far this year, the South Korean stock market's down 1.4%. I think it's a relative value, your point, issue. There are just other places where money goes. We are overweight South Korea. That didn't work for us last year. We were overweight in 2014. The South Korean stock market was down about 5%. Our forecasts are macro business cycle driven, so we don't know the company situation in Korea all that well. So understand that as an information input, we're not bottom-up analysts. We do top-down macro work and come to our asset allocations and our views on markets from that. It looks like, all things considered, I don't think this will resonate here today with what's going on in the world. For the U.S. and global economy, the best is yet to come.
Well, who can be more comprehensive and illuminating than Alan Sinai in covering the global economic and financial terrain? By the way, Alan Sinai, Dr. Sinai is not only an academic and the consultant to private and public sector, but he himself is investor And that's why he is so popular, most popular among the financial communities all over the world. And he's very popular in Wall Street. And actually, Wall Street Journal once they commented on him saying that he is the best in the financial market forecasting area. And so just follow his advice, you will become rich as well. Okay, yes. Mr. Kwan, and then
Thank you very much, Dr. Sinai, for your insightful and then comprehensive with rosy pictures. I have two questions. One is we looked back the oil price from 1980s. There have been 4 or 5 times sharp decline, which means comparing with the peak, more than 40% lower. So the longest period of low oil price duration was 1988-89, 14 months. And what is your forecast for this time? How long will this low oil price continue? And second thing, last night my wife asked me to ask you whether it is the right timing to buy gold.
okay, now, Mr. Chair, please.
Thank you so much for your nice, good lecture, Dr. Sinai. I want to hear from you about some pessimistic scenario. I think there's good chances that Russia and Greece may go defaults. And with the increase of U.S. interest rate, there can be some exodus of dollars from emerging economies. With that scenario, then my concern is that isn't there any chance or possibility of we have to facing global financial crisis? Thank you.
Okay, and then Dr. Kim for the first round. Yes.
Dr. Sinai, it's complete now that you are here. Our JNU is complete. You mentioned many things, but 2 things of your speech are very prominent. One is, of course, oil price, and the other one is quantitative easing. Related to Dr. Kwan's question, now the U.S. is producing 9 million barrels a day, and there have been wide speculation in the press, including Financial Times, that Saudi was playing a chicken's game, hoping that many of the ineffective or inefficient producers will go out of business. Mostly they were aiming at shale producers in the United States. Now, in your opinion, out of 9 million barrels a day, how many of them are viable to continue to produce at the price of 50, and how many cannot continue the price is my first question. Second part is quantitative easing. After the World War I, all those competitive exchange rate war, it became a very bad name to play the devaluation games. Now suddenly it changed the color. It's appearing in the names of quantitative easing because it's produced the same effect, except they just put the different purposes in them. In fact, Abenomics is exactly that. He wanted just lower the value of yen, and then he found a very good vehicle to ride on QE3 because he's copying the United States and the Europeans could not attack that. So now, how dangerous is it that the world is now back to the currency games using the name of quantitative easing instead of just saying that it was a devaluation game? Thank you.
Okay, that's enough.
Those are great questions. I'm going to go from the most recent one because I remember that it's fresher, back toward the beginning, and competitive devaluation. I completely agree with you. What's going on is competitive devaluation. The cover is aiming at inflation targets through quantitative easing, but the effects are the same, and other countries' currencies are being taken down as part of that competitive devaluation. which is going to mute, M-U-T-E, the gains to any one country that come from trade because the currency goes down, and cause even more attempts to do the same. That's part of the view on Japan and another round of QE by Japan. That's risky business. What is different is central banks are running the currencies now in this way. And that's never been true in history. In history, it's always the finance ministers, the government, and the interventions and the words from time to time, please stop, it's getting out of hand. Well, it is getting out of hand. There are dislocations already from these pronounced moves in the currencies and potential unexpected effects from them, which have to do with, say, a country that has dollar debt and whose currency is coming down, and even worse, if that country's an oil producer, that country's a candidate for big trouble. And big trouble is not just economics and finance. It could also be political inside the country. Source of instability, which I would fully expect to happen. Now, they're not going to change their ways. This QE and the blessing of G20, that whatever happens to the currency is okay as long as you're in pursuit of an inflation target. That won't change until G20 changes. And G20 wouldn't change that view until we get some tremendous instability and fallout. And I would be alert to that. I think some of it's already happening. And while that goes on, you'll see volatility, you'll see certain effects in markets, and from the investment side, you need to be sensitive to it. Will it really matter for economies? Not in terms of the business cycle as we see it. It could delay the upturn, but it won't really make a huge difference to the innards of the business cycle as I describe it and see it in terms of the longer term trends. But it will fake you out. And it is new, it is different. So that means it could spoil things. So we have to watch that. On the Saudi game and the ability of producers to stay in the game at, let's say, $50 a barrel. I doubt that the Saudis have a number in mind, but it's reported, and I don't think there's any contradiction, that the cost per barrel of production for the Saudis is under 10. And the break-even point for the budget, and the Saudis do spend a fair amount of money in their economy, is lower than most. So in pursuit of that long-run prize and a piece of that oil prize, I think Saudis play hardball for a long time. That is a subjective view. It's a view on oil, the geopolitics of oil. Yes, I have analyzed, I think, 15 ups and downs in my career of oil prices. The economics are fairly straightforward, but not totally so. A little bit different this time. And the geopolitics are even worse than that in terms of what goes on. And so we're using in our calculations a trend number of $60 a barrel. But that could be plus or minus $30 a barrel. That's the kind of variation that exists. And we have to watch it as it goes. And then as an exogenous factor, we look and see what that does to various economies. So right now, the numbers I gave you, I would shade a little higher because we're running at $45 a barrel or so. And we have yet to see a lot of the positive effects. We're seeing a lot of the supply side effects, which gets to the supply side 9 million barrels a day. And again, this is another subjective assumption. It is that U.S.-based companies are really good at getting costs down. If the prize is a piece of that oil market in the long run, they're going to fire people left and right. They're going to cut costs everywhere, but they're going to try and keep production up and lower the break-even point of producing in the new way. The new way now is about 30% of the 9 million barrels a day. Probably that'll be 50% in a couple of years. So we think U.S. supply will stable to higher, but will not go down materially. We're watching how the companies are behaving. If you look at Schlumberger and a number of other companies, they are firing right away, right and left, to get costs down. That's the biggest cost. It's murder for people in the energy sector. The energy sector profits in the S&P 500 are going to get slammed initially, And we're not suggesting to anybody that there's a bargain level because we don't know where oil prices will go. But we do have confidence that the U.S. suppliers will be able to fend this off. We do not, though, with regard to Venezuela, with regard to Nigeria, Algeria, even Iran. They may behave differently politically because of this. And in the geopolitics of the West versus Russia, who's to say that without saying it, the U.S. is not happy about the stranglehold on Russia of this move down in oil prices in the hope that Vladimir Putin will be more agreeable. He's been silent on oil. I don't know what a corner tiger does. He's a tiger, and that's another uncertainty. So, look, all these optimistic forecasts, the amount of volatility and things that can go wrong, because things get out of control, can be very high. Now, on the second set of comments, which has to do with another global financial crises, in part from the currencies and movements of monies and dollars flowing out of some developing countries, I think not all, but certainly Venezuela, Russia, Mexico, some of the frontier countries in the Middle East, not so much emerging Europe nor emerging Asia because they're not hit by oil prices, they're actually helped. I think we are seeing tremendous movement of monies out. You know that from the currencies, the ruble collapse. And the question is whether the exposures to countries who are highly indebtedness as a percentage of GDP and who have a lot of, say, dollar-based debt or Swiss franc-based debt now are such that financial institutions will be harmed a great deal, and that in turn will cramp through contagion, really, economies and give us a global financial crisis. We don't think so, but we think in certain places we'll have that. The economics of how Russia impacts the world economically are really fairly small. It's centered around a bunch of neighboring countries. The Eastern European countries are tied more to the trade of Europe and Western Europe than they are to Russia. It's pretty contained, so not on economics. The problem lies in what Russia does in response to these troubled times. And what one day, if we wake up, Russia has devalued and defaulted, the markets do. But market movements come and go. That wouldn't change my mind. If Europe, somehow, all things considered, economies slide in growth, we'd be worried about that because that's over 20% of the world economy. And not all the EMG countries are going to have the problems that your questions raised. So I think I wouldn't discourage anybody from thinking about default of Russia. I'd actually encourage that, though it's low probability, but I would encourage that. And as far as Greece goes, that's another issue, which is whether the Eurozone holds together. And I never thought it could, and we're showing signs again of potential of a Eurozone breakup. That will create chaos in markets. Without political union, I've never thought it could work. We don't have political union in Europe. I think we never will. And so the costs and benefits of a Eurozone breakup, a tier of economically strong countries versus a tier of weak countries, a euro that is for a smaller set of countries always made a lot more economic sense as an eventual result for me than anything else. But we'll see. We have an election in Greece. Right now, the out-of party is favored. We'll have tough negotiations with the center of Europe. They've sunk 240 billion euros into Greece. That was a business mistake, but politically, I think we understand why they did that. They ought to be willing to let Greece go. Greece would be better off. Italy would be better off, in my view, economically, if they had control over their own destiny. They don't now. And certainly the UK is very smart to be thinking about leaving the EU and staying out of the Eurozone. Then we have a couple of more plain vanilla questions. I'll go to the spouse first. When wives have something they want to do, I think we don't want to stop them from doing that. And when it comes to intuition and investments in markets, women are, and we do have a relatively small number of women here. I say this not in jest. I say this sincerely. Having been trained by my wife of 51 years, trained or what I say, beaten up, 51 years. The women have incredible common sense and intuition. So if she thinks she ought to buy gold, she can buy gold. Now, we were bullish on gold for 11 years. Goes back to the early part of the decade. We got bullish on gold when it was $350 an ounce. I started buying personally at $550 an ounce. And I would carry gold bullion around with me to show everybody how smart I was. And I bought some of that at Harrods in London at $11.50. And gold went, our forecast, we had it up to 1900. We forecasted 2200, it didn't get there. And we got bearish on gold. Why? Because it's a hedge against currency devaluation. It's a hedge against inflation. It always holds its value. And with the prospect for the U.S. that we're going to raise rates, the dollar's looking so good, gold didn't look like a good deal. So we have been neutral to bearish on gold, most of the time bearish for 3 or 4 years. However, right now, at these levels, because currencies are going way down, inflation is tilting down somewhat mysteriously around the world. Gold has appeal. But she needs to watch that gold closely. And so maybe she won't be cooking meals for you. She'll be watching gold. I'm not sure I want to encourage that because it, as you know, is very volatile. But yeah, we would be neutral to tactically positive on gold because of the chaos that's going on in the world. And there was gold and oil prices, how low for how long. That really is the toughest of all the, they're all tough. They're good questions. Of all the questions, I think the Saudis are in it for the long haul. And there's going to be, it's a real war between the Saudis and the oil shale producers in the United States. And $110 a barrel, $100 a barrel was way out of whack anyway in the deflationary world. So a range of 25 to 60 makes more sense. So I think they're down for a long time. Now, whether we bounce back up later on this year and then bounce back down or have another big downturn is very hard to call at this point. I would vote to be surprised on the downside with upside intermediate moves, a lot of volatility. But again, here is really a problem for everything in forecasting this year, and so many businesses, so many investors, because of the power of crude oil and natural gas as an energy resource in the markets and the economy, and for those who are owners of them. We went 3 years with oil prices in the $105 to $115 range, stable. That is rare for this asset price. We should not expect that going forward.
Okay, maybe one or two last questions, and we have to let the Dr. Sinai go for other.
Thank you, Dr. Sinai. As when you mentioned Japan, you didn't say anything about the so-called third arrow of Abenomics, the structural reforms. I guess because you were primarily focusing on QE globally. Since you'll be going to Japan tomorrow, you may probably say something about the need for structural reforms and how that's all tied up with mid to long-term Japanese growth. Can you share your view on that?
Yes, I was saving that for Japan. When I get asked, as I sometimes do by policymakers, what do we do? For years I was telling them, you've got to get the currency down, that's your only way out. And with long lags, they finally took that advice. They did it not the way I thought, and I told them they should, which is by MAF intervening to show the government was behind a decline in the currency. But they cleverly, and they outsmarted me, did it through devising an inflation target, installing their own people at the Bank of Japan. That is indeed what has happened. Under the cover of, blessed by the United States and Ben Bernanke, we did it first, so we could hardly complain. really cleverly taking it out of the bailiwick of the Ministry of Finance and the government. But you know, in Japan, and this is in part going to the third arrow, I think it's all one and the same. So when I think of the Bank of Japan, this is not quotable for the press, by the way. This is only for this room. This comment is off the record. Everything else is on the record. I think of the goals the same. So I think of Abe as Kuroda and Kuroda as Abe. And the head of the Ministry of Finance, I'm not even sure I know his name. That's why be sure I'm going there. So be sure this is not quoted in the press here. The Japanese read everything.
신문에서 언론에서는 이거는 커버하지 마세요. 일본 가니까 일본 못 들어갑니다. 이거 하면
Right, because I'm saying this somewhat in a teasing fashion. And I don't think the Japanese will take it that way. I thought from the beginning, and that's a few years ago, that this was the Abe event was huge in a seismic shift in Japan because the policymakers were going to all be on the same page. If you look at where Governor Kuroda came from. And that through one way or the other, the so-called three arrows would be delivered over time. That means reform, still not delivered, but delivered. Now the reform and the kind of structural changes which a lot of countries should do but don't do, it has to do with long-run potential growth and the ability of the Japanese economy to grow by more than 1 or 2% a year. And I believe we will see that evolve over the next year or two. But there's a sequence here. You really have to get the economy up and running, start to steer inflation back to 2%, do the right things fiscally, at the same time politically try to get in elements of structural reform, which indeed the Abe administration is attempting to some extent. And the election, the recent election, will help. So I think when I go there and dig into the longer run prospects, I will find feedback that will tell me it's in process and it will come. And that is the assumption and forecast that I make. So that then circles back to the view on Japan in the future, with all of its aging problems, all of its immigration problems, the homogeneity of the population, rigid ways of doing things, all of the things we know about Japan, that the Japanese model of 30 years ago, which looked so good, didn't turn out to be so good. I'm on record, I continue to believe that Japan will emerge from this 2 to 5 year range back. And that is heavily dependent on a political assumption. And so far I see everything clicking in the way it has to click in. They made a mistake on fiscal policy. They're fixing it. They have a small amount of fiscal stimulus, and they're going to cut corporate taxes. They should cut individual taxes. Japan doesn't want to do that because they need the money for an aging population. They should cut, because the growth they get will help bring in tax revenues and help finance the older population. They should ease monetary policy more. It's a freebie on the budget. It costs nothing on the budget to do more quantitative easing. It keeps interest rates low, interest charges on the budget less. There is no hit to the budget. Yeah, it's a fiscal action, but there's no hit to the budget. These are things they should do. And roughly, they're moving in that direction. The private sector of Japan is going to be very slow. It's slow for the big move up in the Japanese stock market to translate itself into more consumer spending. But right now, I would say the third arrow is in process. You can't see it clearly. It will come. That's a forecast and assumption. And Japan, over the next year from now to 3 years from now, is going to do a lot better. And the demands from Japan of what they buy from Korea will be part of the very nice growth pace for Korea, relatively speaking, that we are projecting.
Well, after all, you didn't say anything bad about Japan anyway, and you said you've been very objective, and we hope Japan will do better by all means. Japan is the third largest country in the world in any way. So anyways, we can go on like this all day with Alan Sinai, and he can be a very good personal consultant to all of you to manage your own portfolio. But in any case, we have to end here, let him go, and he has other appointments. And the best part of his presentation today is the last message, and that is that the better things are ahead. And maybe this year, toward the second half of this year, even the Chinese economy and the global economy will start to get better than now. And so we should be looking forward to improving the global economic situation. Well, we have to end now, and we're looking forward to next year. Maybe before next year, we may bring him back again and with good messages. Well, with this, again, join me in thanking him.
Thanks.